Welcome back to the channel. Today, we're diving into a crucial topic for small business owners, LLC versus sole proprietorship. If you're just starting out, or even if you've been in business for a while, this video is for you. Choosing the right legal structure for your business is a big decision, one that can have major implications come tax time. We're going to break down the differences between these two popular options, focusing specifically on the tax implications of each. We'll look at how each structure affects your personal income tax liability, the different types of taxes you'll need to pay, and potential strategies for minimizing your tax burden. By the end of this video, you'll have a clear understanding of which structure might be the best fit for your unique business needs. So, let's get started. Before we dive into the tax implications, let's make sure we're on the same page about what these two structures actually are. A sole proprietorship is the simplest form of business. You are the business, and the business is you. There's no legal distinction between you as an individual and your business. An LLC, or limited liability company, is a bit more complex. It creates a separate legal entity for your business. This means your personal assets are protected from business liabilities. This can shield your personal savings, house and car from business debts. Now, you might think an LLC is the obvious choice for protection, but liability protection isn't always the deciding factor, especially with taxes. The tax implications of each structure can vary greatly. For example, with a sole proprietorship, all business income and losses are reported on your personal income tax return. This means you'll be taxed at your individual income tax rate. An LLC offers more flexibility when it comes to taxes. You can choose to be taxed as a sole proprietorship or a corporation. This choice can significantly impact your tax liability. So, the decision between an LLC and a sole proprietorship is not as simple as it might seem. Carefully consider your circumstances, business goals, and tax implications before making a decision. Let's dive deeper into the tax implications of a sole proprietorship. As I mentioned earlier, the biggest thing to remember is that with a sole proprietorship, you and your business are considered one and the same in the eyes of the IRS. This means you'll report all business income and losses on your personal income tax return using a Schedule C form. The beauty of this is that it's relatively simple and straightforward, especially compared to filing as a corporation. However, this simplicity also means you're taxed on all business profits, whether you take them out of the business or not. So, even if you reinvest all your profits back into your business, you'll still owe taxes on that income. Another important tax consideration for sole proprietors is self-employment tax. Since you're considered self-employed, you're responsible for paying both the employer and employee portions of Social Security and Medicare taxes. This self-employment tax rate is currently 15.3%, which can be a significant expense for sole proprietors. However, there are ways to minimize the impact of self-employment tax, such as deducting a portion of it on your tax return. Despite these tax obligations, there are some potential tax advantages to being a sole proprietor. For example, you may be eligible for the Qualified Business Income (QBI) deduction, which allows you to deduct up to 20% of your qualified business income. This deduction can significantly reduce your taxable income and ultimately lower your tax bill. Additionally, sole proprietors can deduct a wide range of business expenses, such as office supplies, travel expenses, and even health insurance premiums. Overall, the tax implications of a sole proprietorship are relatively straightforward, but can be significant. It's crucial to carefully track your income and expenses, take advantage of all eligible deductions, and consult with a tax professional to ensure you're minimizing your tax liability. Chapter 3. LC. Unlocking tax flexibility. Now let's shift gears and explore the tax implications of an LLC. One of the most significant advantages of an LLC is its flexibility when it comes to taxes. Unlike a sole proprietorship, an LLC can choose how it wants to be taxed. By default, an LLC is treated as a pass-through entity by the IRS. This means that, similar to a sole proprietorship, all business profits and losses are passed through to the owner's personal income tax returns. However, an LLC can also elect to be taxed as an S corporation or a C corporation by filing the appropriate paperwork with the IRS. Each of these tax classifications has its own set of advantages and disadvantages. Electing S Corp status can be beneficial for business owners who want to minimize their self-employment tax liability. With an S Corp, you're considered an employee of your own company and only pay self-employment tax on the salary you draw from the business. However, S Corp come with their own set of rules and regulations, and you'll need to pay payroll taxes on your salary. C Corp, on the other hand, are separate legal entities for tax purposes and pay corporate income tax on their profits. While this might seem like a disadvantage, C Corp can offer significant tax benefits for businesses with high profits or those looking to retain earnings within the company for future investments. However, C Corp are subject to double taxation, meaning that profits are taxed once at the corporate level and again when distributed to shareholders as dividends. Choosing the right tax classification for your LLC is a crucial decision that can have a significant impact on your tax liability. It's essential to consult with a tax professional to determine the best option for your specific business needs and goals. Chapter 4: LLC versus Sole Proprietorship Tax Showdown. Now that we've covered the tax implications of both LLCs and sole proprietorships, let's compare the two head-to-head. When it comes to simplicity, sole proprietorships definitely have the upper hand. With a sole proprietorship, you're only dealing with one tax return, and the filing process is relatively straightforward. LLCs, especially those taxed as corporations, can have more complex tax requirements and may require the assistance of a tax professional. However, LLCs offer greater flexibility and potential tax savings, particularly for businesses with high profits or those looking to minimize self-employment taxes. The ability to choose your tax classification gives LLCs a significant advantage over sole proprietorships in terms of tax planning. Another key difference is liability protection. LLCs offer personal liability protection, meaning your personal assets are shielded from business debts and lawsuits. Sole proprietorships, on the other hand, offer no such protection, putting your personal assets at risk. Ultimately, the best choice for your business depends on your individual circumstances, risk tolerance, and long-term goals. If you're just starting out and have minimal liability concerns, a sole proprietorship might be a good option. But if you're planning for significant growth, have substantial personal assets to protect, or want greater tax flexibility, an LLC might be the better choice. Remember, there's no one-size-fits-all answer, and what works for one business owner might not work for another. Chapter 5: Making the Right Choice, Your Business, Your Decision. So we've covered a lot of ground today, from the basic definitions of LLCs and sole proprietorships to their distinct tax implications. Remember, this is your business, your hard work, and ultimately, your decision. Choosing the right legal structure is a crucial step in setting your business up for success, both now and in the future. Don't be afraid to ask for help. Consult with a tax professional, a business attorney, or a mentor in your industry. They can provide personalized advice based on your specific situation and help you navigate the complexities of business formation and taxation. And remember, this isn't a decision you have to make in a vacuum. As your business grows and evolves, your needs may change. You might find that a sole proprietorship no longer suits your needs, or that an LLC's tax advantages outweigh the added complexity. The good news is, you can always transition from one structure to another down the line. It might involve some paperwork and legal fees, but it's entirely doable. The key is to stay informed, be proactive, and adapt as needed. Starting and running a business is a journey, and like any journey, it's best to be prepared. By understanding the nuances of LLCs and sole proprietorships, you're taking a proactive step towards building a solid foundation for your business. Thanks for watching. If you found this video helpful, make sure to like, subscribe, and hit the notification bell for more content like this. Understanding the tax implications of your business structure is crucial for maximizing your profits and achieving your financial goals. Remember, this video is for informational purposes only and shouldn't be considered professional financial advice. Always consult with a qualified tax professional or business attorney for personalized guidance tailored to your specific situation. Drop your questions in the comments below and I'll see you in the next video.